There are a lot of moving parts impacting the markets today. The Fed meeting this week was short lived because of all the geopolitical unrest in the world. However, the Fed meeting was important. There was a lot that came out of that. So I want to focus on two things today. The first one is the portfolio. As always, it's totally transparent to you. I want to show you the transactions that we make as well as the dividends that we receive and the options transactions that we have. But secondly, I want to talk about the Fed meeting and what they decided to do and how that might impact us as dividend growth investors in the future. So if you're interested in seeing not only the portfolio, but my take on the Fed meeting, stay tuned. Hey guys, Kevin Burgess back yet again with another video. This has been an interesting week. The Fed meeting occurred on Wednesday, and I was not able to watch during the day, but at the end of the day, I went to the television and I was going through CNBC, Fox Business News, could find nothing on what Jerome Powell had talked about. So I had to actually do some research on it, and most of the coverage was obviously, and rightfully so, on the war in Ukraine. So today I want to focus on two things. One is the portfolio, but the second one is what the Fed moves might mean to us as dividend growth investors. What is it going to do to the markets in the short term versus the long term? And what kind of history can we look at to try to get a sense for where this is heading? With that, let's get started. So the update on the dividend growth portfolio, I like to show this chart at the beginning of the videos because we have new viewers every week, and I am so appreciative of you guys joining us. But I do split my dividend growth portfolio into two portfolios. One focuses more on higher dividend growth, and the other focuses more on higher dividend yield. The reason I have a portfolio focused on yield is that I am retired and I have several passive income streams, but this is one of them. So the dividends off of the yield portfolio, I can use if I need to pay for expenses that I have just for living life. Dividend increases and decreases for the year. You can see we did not get any new ones this week, but you can see we've had a pretty good quarter thus far, and it's been really nice to see. The portfolio for the week ending March 18th is up $19,006. You can see that of that $19,006, 591 or so were dividends. $69 were related to the closed options positions that we have. And then the market change was 18,347. That's a 2.3% increase for the week, which is pretty good until you compare it to the S&P 500, which went up 6.2%. So we trailed the S&P 500 by 3.9% this week. It's kind of understandable based on the mix of stocks we have in the portfolio. I look for lower beta stocks, so we don't typically move as much as the S&P, but that's a pretty big change. But if you look at year to date, the portfolio is up $59,000. Of that, we've contributed $42,000. Dividends are $5,500, and closed options transactions are $400. So our market change is $10,993, or 1.5%, versus the S&P 500, which is down 6.4%. So still on a year-to-date basis, we are outperforming the S&P 500 by 7.9%, and I'm pretty happy about that. But look at this options total for the year of $400. If I hadn't decided to play around with turbocharging my dividend yields, that $400 wouldn't be there. And if you look at the 400 compared to the $2,200 of dividends, I mean, you're looking at almost 20% bump, turbocharge of the dividend yield. So, I'm pretty happy about that. The yield portfolio, I didn't buy anything or sell anything this week. You can see that my cash secured puts reserves are 5,100. You'll see that transaction here in a minute. I now have about almost $15,000 to invest this week. This is not terribly alarming because I will enter into another cash secured put, and we'll need some capital, obviously, to do that. If I look at the turbocharged yield update, the poster child for this strategy is Campbell's Soup. If you look, I own 100 shares of Campbell's Soup. The dividends are $148 per year, and it equals about a 3.57% dividend yield on cost for me. The transactions that I've done for covered calls related to Campbell's Soup have resulted in almost $139 of additional funds, which is a 3.35% yield on cost year to date for Campbell's Soup. If you look at it, $139 is almost as much as the annual dividends of $148. So my total yield on cost for Campbell's Soup is approaching 7%. So it's a great example of how these options, covered calls, as well as cash secured puts, are turbocharging my dividend yield. You'll also see at the bottom here, I did have some other cash secured puts this week that were not assigned and expired. So you'll see that my annualized yield on those transactions to date are 16.7%. You'll see I have two open options positions. One is the one for New Jersey Resources, which is going to be open probably until the middle of April. I did enter into Friday another cash secured put for Verizon with a strike price of $51. That's the cash reserve you saw on the other slide of 5,100. If this does not get assigned and it goes to expiration, it would yield about 25%. So that's not a bad not a bad transaction. In terms of dividends received on March 15th, I got two in this portfolio, which is Kellogg's for $58 and Main Street Capital, which is my only monthly dividend payer, at $86. In the growth portfolio, I didn't buy or sell anything this week, and I still have about $17,000 to invest. I'm not overly concerned with that because if you think about it, it's probably about 3% of the growth portfolio. And I don't feel bad having 3% cash sitting on the sidelines at this point. In terms of dividends for the growth portfolio, I got three. One is Steppen for $33.59, Tyson, $60.83, and Whirlpool, one of my larger holdings, for $352.52. What are my plans for the week? Well, I want to look for some deeply discounted growth opportunities for the growth portfolio. If I want to put that $17,000 to work, I need some compelling story to invest it in. Then secondly, to build a larger portfolio of open options positions. I don't want to go crazy here, but I would like to have 4 to 6 open positions that I'm managing. And then thirdly, I want to research potential higher yielding stocks to add to the yield portfolio. As the stocks have gone up, especially in the oil and gas sector, it's creating some lower yields moving forward for those stocks. And so I want to take some time to look for additional stocks that would provide yield for the portfolio. So now moving on to the Fed, what did they do this week? They raised interest rates, and then they also plotted a series of hikes to fight inflation. So to provide some background, the Federal Reserve on Wednesday raised rates by a quarter percentage point and laid out a plan for more aggressive ongoing increases in the months ahead as they try to combat higher inflation. And they also recognize that the conflict in the world could cause a delay in the slowdown of inflation until later in 2022. So they pretty much have given up on the first half of the year in terms of taming inflation. So the Fed chairman said that the risks of a recession over the next year are low. I think that's the best he knows at the point, and I think maybe he's trying to calm the market. But we'll just have to see where the economy goes from here. In terms of the balance sheet at the Fed, they are now looking to shrink the balance sheet as soon as the next meeting on May the 4th. The financial markets are expecting the Fed to raise its policy rate by 6 quarter point moves this year. So 6 quarter point moves would be a 1.5% increase in the Fed funds rate. This is an interesting chart of the blue line being the Fed funds rate throughout time from 1955 until 2020. You can see that there have been times of increasing Fed funds rate, decreasing Fed funds rate. These gray columns represent recessions. So as we look at interest rates rising, recession hits, interest rates come down, they rise, recession hits, interest rates come down. And you can see that pattern kind of throughout. There are times that it doesn't happen, like here, the rates moved higher, and then they kind of leveled them out, and it worked out pretty well until here they raised them again, and then a recession hit. And so you can see here the Fed using the Fed funds rate as a way to try to keep us between the guardrails. On one side is inflation would be kind of out of bounds, and then the other side would be a recession, which would be out of bounds. So they're trying to keep us inside these guardrails of inflation versus recession. So what does this mean for us? What's the impact of the Fed interest rate hikes? Well, you can see here in this article, he talks about higher rates can incentivize investors to sell assets. Another interesting point is that as interest rates rise, higher yield savings accounts as well as CDs might look more attractive for more conservative investors. And that's a real concern. However, when we look at the 5 most recent rate hike cycles, what does that say about what happened in the market? And according to this article, there's the rate hike cycle between February 1994 to July of 95. The S&P went up 13.8%. So if we look back at this chart, we can see that it's this rate hike series right here. So during this time frame, when the Fed funds rate went up during this time frame, what happened was the S&P went up 13.8%. There's only been one time in the last 5 rate hike cycles that the market did not go up, and that was in the June 1999 to January 2001 series. You can see that here, this session right here. And then all of a sudden, not only did a recession hit, but also the S&P went down 5%. So there is another thing to think about in this time frame, which is the dot-com bubble. So we can somewhat discount that. So 4 out of the 5 times we've had a rate hike cycle, the market has gone up. The median change in the S&P 500 during that time is 30%. And even in 2017, the Fed raised rates 3 times and the S&P 500 climbed more than 18%. So that's more of a longer term look, but what about in the short term? What do we expect on like a 1-day, 1-month return? That's kind of a mixed bag. It's minus, plus, minus, plus, minus, plus. So I think the thing to point out here is that for buy and hold stock market investors, which is what we are as dividend growth investors who have a longer time horizon, the Fed rate hikes may not be a bad thing. So based on this, as a dividend growth investor and one who likes to buy and hold, I'm a bit encouraged by this news. I think raising rates actually might be the right thing to do. So I'm not going to be afraid of this market. I'm going to continue to invest. I know there are people out there who believe a recession is coming, but I'm not sure that a recession equates to the stock market decreasing. So if you're new to this channel and you like dividend growth investing, or maybe you're new to dividend growth investing and want to learn more, if you like this video, please give it a thumbs up. It'll let people know that there's good content inside here. And then if you want to see more videos about dividend growth investing, consider subscribing to the channel. I'd love to have you along on this journey with me as we seek for personal freedom. It's important to point out that I'm not an investing professional. And while I'm happy that you're here on this journey with me, it's important that you do your own due diligence before selecting stocks to purchase. So with that, I will see you on the next video.